Welcome to our webinar entitled How to Sell Your Business, Tips for Lawn and Landscape Business Owners. My name is Ron Edmonds, and I'm president of the Principium Group. Principium specializes in mergers and acquisitions, exit planning, and capital formation for the green industry. This is one of a series of webinars sponsored by the Principium Group for lawn and landscape business owners. This particular one is fairly basic in nature. We will be sponsoring additional webinars which will explore many of the topics covered today in greater depth. So let's go ahead and proceed. Our agenda today, I'd like to quickly review, includes understanding your objectives, deciding to sell your business or knowing when the time is right, understanding the value of your business, preparing your business for sale, choosing your advisors, an overview of the typical selling process, and questions and answers. Our first topic is understanding your objectives, which may be more complicated than it sounds. Objectives can fall into two categories, financial and non-financial. Financial objectives typically include realizing a certain value for your business and ultimately having sufficient assets for retirement or the next phase of your life and possibly providing value to your heirs. Non-financial objectives often include such things as seeing the business you've built survive and prosper, rewarding the employees who help make it happen, passing the business on to family members or perhaps others close to you. In most cases, the most important objective is to be financially stable after the sale, so these non-financial objectives usually take a back seat to financial ones. Before proceeding with the sale of your business, however, it's a pretty good idea to sort out those overlapping or competing objectives, which may include your personal finances, your family members, employees, customers, and for many of us, our business legacy. Let's talk about deciding to sell your business. Unfortunately, most business owners let circumstances make that decision for them, which is a big obstacle in achieving their objectives. In deciding if you're ready to sell your business, here are some things to consider. Are you mentally ready to sell your business? Almost everyone that I talk to about selling their business says initially that they are ready to sell their business. But I like to ask some questions, such as, can you imagine someone else running your business on a day-to-day basis? And do you know what you're going to do after you sell your business? Those are things that will affect your mental readiness to go ahead and proceed with the process. Are you financially ready to sell your business? Do your own assets right now, along with the anticipated proceeds from selling the business after tax, provide you with sufficient resources to achieve your objectives following the sale, which might include retirement or starting a new business or lots of other things? Then is the business itself ready to be sold or transferred to a family member or other one? And lastly, are market conditions favorable? Because if all those other factors are there, but market conditions are not favorable, it isn't the right time to sell your business. Let's talk about the value of your business. This is one of the hardest areas for most business owners to grasp. And frankly, most business owners believe that their business is worth more than it actually is to a new owner. And frankly, that makes sense when you take a step back and look at it. You understand your business, you know what to expect, you know how to control what's happening in the business. All of those are things that are uncertainties to a new business owner and cause the value of your business to go down in their eyes. First of all, no matter what rule of thumb you may have heard, a business's value is almost always based upon expected cash flow from the business. There will be a range of possible values for any business, And certain characteristics of the business we'll call value drivers specific to the business will determine where on that range of values a particular business will ultimately be valued. For example, you may hear the range of 2 to 4 times adjusted EBITDA, earnings before interest, taxes, depreciation, and amortization is appropriate for a particular kind of business. And that's a very wide range. The high end of the range is double the value of the low end of the range. And so what characteristics, the question is, what characteristics of the business will cause a particular business to sell at the high end of the range rather than the low? We'll talk about that more in just a moment. But certainly valuation is not a simple process and requires professional judgment. Usually you'll need the help of someone with a background in business valuation, be that a business broker, a business valuation specialist, or an accountant, to help you understand where you really stand in terms of valuation. This slide illustrates the interrelationship of various value drivers that may affect the value of your business. And let's quickly review those. As I indicated to start with, cash flow and expected future cash flows are going to be the biggest single factor in determining value. The area in the slide in red, financial performance, includes some of the value drivers that fall in that category. You know, how profitable has the business been historically? What cash flow has the business generated? How has the business grown, and what are the growth prospects for the business? Those are all very important questions that are pretty easy for someone to understand. I've added another, working capital requirements, because that's something that people often forget about in the valuation process. And when I say working capital requirements, you know, if a typical format of the sale of a business in our industry would include the sale of the fixed assets and goodwill of the business, with the cash and accounts receivable staying with the seller and the liabilities being paid off by the seller. The question is, in addition to buying the business, what capital will the buyer have to put in to keep the business running? That can vary dramatically based upon how the existing business has been run. For example, in the case I've just been working on not long ago, in a landscape maintenance business, some businesses bill for monthly services at the beginning of the month, and some bill for monthly services at the end of the month. And so if you're a buyer of a company in that industry, and you buy a company that bills at the beginning of the month, and you're going to close at the first of the month and immediately send out bills for the following month, you're going to have cash flow generated in the first month. On the other hand, if that business has contracts that provide for billing in arrears at the end of the month, then in addition to the cost of buying the business up front, the buyer is going to have to inject enough capital into the business to keep it running until cash flow starts coming in, which in that case might be 45 to 60 days out. And that could be a fairly significant difference, and that difference will very much affect how much a typical buyer would be willing to pay for the business taken as a whole. They're going to factor in the total cash outlay, not just what's going to be paid to the seller of the business. Some other value drivers that are significant are revenues. How are revenues generated? Are a significant portion of revenues recurring revenues every month? Is there a machine that generates sales? By machine, I mean, is there a system that generates sales, or is every project individually sold? And if so, who sells them? Is there a team that handles sales, or is it mostly handled by the owner? Those variations are going to affect the value of the business. Certainly the market image, the view of the competitive position in the business, the brand name of the business are going to be significant. In many cases, if not most cases, the quality of the employee base, including both management and staff, how strong they are, how long they've been around, are all going to affect the value. Similarly, the customer base. How large is the customer base? Where do customers come from? Is the customer base stable? Are there a significant amount of recurring revenues or repeat business from the same customers? Is the business overly reliant on one or two customers or one or two areas? A physical area or an industry that they serve? You know, the more concentrated it is, the more risky it's going to be to the new buyer. Physical assets are a factor in the value, including the quality and age of the equipment, the location, the physical facilities, the condition of the premises. All those are going to have some impact as well. Although usually those are more negative if there's deferred maintenance or problems than they are a real big positive. We're often asked how to prepare one's business for sale, and the answer is really not too complicated. I'm reminded of the classic inspector from the TV news programs that go into restaurants and check them out and then say, clean it up. Well, clean it up literally and figuratively is one of the most important things you can do. Take a look at your business and find those aspects that can be changed to make the business more attractive, both physically and qualitatively about the business. Eliminate obstacles. If there are important matters like tax issues, litigation, forgotten promises of equity interest to key employees, now is the time to take care of them. They will come up in the process, but these issues will usually not make it impossible to sell your business, but will definitely slow down the process if they're not addressed up front, and certainly if not disclosed to a buyer. And then take steps to improve the value of your business. And, you know, one of the good things is that these steps are the same as what you ought to be doing with your business anyway to make it the most valuable business for you, whether you're going to sell it or not. But go back to those value drivers we talked about a few minutes and focus on those that you can control. Some of them are beyond your control or may take too long to modify based upon when you plan to sell your business. But focus on drivers you can control. Focus on increasing the earnings and the cash flows of the business. Focus on the fundamentals. Focus on emphasizing those service lines that will be most attractive to buyers, pricing strategies that both are productive currently and attractive to buyers, targeting markets and customers that a buyer for your business will be interested in, physical locations and your employee base. Some other things you can do to significantly improve the value of your business are make your business less dependent on you. This is a concept that is extremely important in understanding the business sale process and one that people often don't have a good understanding of. The more dependent the business is on you as the owner, the less attractive it will be to a new owner who can't depend on you being around. And so making that business function without you is a great idea. One of the steps in that is implementing quality administrative systems and procedures. Write down what you do and the systems that you have your employees handle, which will demonstrate that the business is not as dependent on you as it might appear. Maintain good financial records, it goes without saying. Maintain a distinction between business and personal affairs, which is often an issue for small business owners. But the more complicated sorting all that out is, the more difficult it will be for a buyer to comprehend the full value of the business. And certainly retaining quality advisors to help you through the process will help improve the value of your business as well. We'll talk more about that in a moment. Let's talk about who will buy your business. There are lots of possibilities in different circumstances. It may be a competitor who wants to increase his market share. It may be a customer who wants to ensure their supply process. It may be a supplier who wants to ensure that they continue to have a customer. You may have one or more employees who may be logical buyers for your business. Similarly, a family member may be obvious. Another option is a similar business in a nearby community that wants to expand its base, its territorial base. Another option is a complementary business, a business that perhaps serves the same customer base with other services. An example in our industry might be a garden center acquiring a landscaping business, or vice versa, which is fairly common. Or a landscape business acquiring an irrigation business. And lastly, I've put in a corporate refugee. That actually is a fairly common occurrence in our industry, where we have people who are coming out of the corporate world who may have early retirement packages or severance benefits, or a large 401k that gives them some cash to consider an acquisition. Who've always wanted to own their own business, and rightly or wrongly, the green industry is pretty attractive to some of those people who've been cooped up in offices for years. Let's talk about assembling your team. Who will be on your team is going to be a little different in each circumstance, but in almost every case, you're going to have an attorney involved, an accountant, typically your ongoing accountant, that a tax advisor who might be your attorney, your accountant, or possibly someone else, a wealth planner in terms of evaluating what kind of resources need to be created to generate your retirement or other post-transaction lifestyle, and usually a business broker who serves as an intermediary and guides you through the process. A word about selecting the members of your team. While you probably have an attorney and accountant already, it doesn't necessarily have to be the same attorney you use on day-to-day matters that would handle a transaction like this. Important things are that they have experience in business sale transactions, number one, and number two, that they have a mindset of being a deal maker instead of a deal breaker. A lot of times advisors can be overly negative to the process, and sometimes that's just because of their own nature, because that's what they view their role as finding all the downsides and negotiating the best deal possible on your behalf, which is what they should do. But ultimately, the goal is to get a deal done, and some people just seem to have the knack of being deal makers, and others are deal breakers. A business broker or merger and acquisition intermediary is often a part of the process too. Not always, but in most cases, you're going to get a better result if you do involve an outsider in that process. Sometimes your attorney or accountant can help play similar roles. But a business broker is going to be able to advise you on the value of your business, may know potential buyers, and can help you through the process. Importantly, one of the things they do is allow you to continue to focus on keeping the business running effectively while they quarterback the sales process. It's very easy for a potential seller to get very interested and involved in the day-to-day process of selling the business, and as a result, let their supervision of the business deteriorate. And nothing is worse on trying to get a deal done than to see a company in decline because the owners are focused on the sales process as opposed to keeping the business running on all cylinders. Business brokers come in a lot of different flavors. Ones in most any locale that are generalists. There are specialists in most industries, such as what we do, focusing on mergers and acquisitions within lawn and landscape type businesses. Either way can work for you. Most important thing is to find somebody that has good credentials, a good track record, references you can check, and are committed to the process. Let's talk about the typical selling process. And this is the process that we typically go through, and it's basically similar to how most business sales are handled. The first step is to, after analysis of the company and kind of agreeing on an evaluation scenario, is to develop a confidential information memorandum that documents the business for the purpose of the buyer's review. It will provide lots of information about the business, employees of the business, the customers of the business, the market served, the prospects of the business, the financial results, the physical assets. Again, depending upon the business, that might take 10 to 30 pages in length. That document is held in confidence. Usually the business broker will quarterback its development, but in some cases someone else might. After that is done, a simple version, what I call a no-name teaser profile, is prepared. It's maybe a 1 or 2 page description of the company that doesn't identify it by name or in enough detail for most people to be able to identify it. That's used as an advertisement, if you will, with potential buyers. So the business broker contacts potential buyers with the teaser profile to ascertain their interest. They may make those contacts in a lot of different ways, through a mass mailing, through contacts they already know, through advertising on the internet in various ways, including a couple of well-known databases of businesses for sale, bizbuysell.com and bizquest.com. Once a potential buyer expresses interest in the opportunity, then they're asked to complete a confidentiality agreement and provide qualifying information so that we know if there is a good fit and the buyer is interested, that they have a real possibility of being able to obtain sufficient financing to complete the acquisition. After we go through that process, the confidential information memorandum is provided to the potential buyer. After they've had the opportunity to review it and ask questions, then it's time to just solicit, negotiate an offer from the buyer. Yeah, it's hard to say how many people would you have to go through to get to that stage. It varies dramatically based upon a whole lot of factors. Once an offer is received, there's a period of due diligence during which the buyer can inspect the business in various ways. At the same time, the attorneys begin to prepare deal documents, and then ultimately the transaction's closed. Okay, let's look at a few questions now. The first question we have is, I understand that a multiple of EBITDA is usually how value is determined. What is EBITDA and how is it calculated? So EBITDA by definition is earnings before interest, taxes, depreciation, and amortization. That number takes net earnings and adds back taxes, interest, depreciation, and amortization. They usually also make an adjustment for miscellaneous other income and expense that are not related to a new buyer. One issue about EBITDA is that many smaller companies maintain their books on a cash basis for income tax purposes, and that doesn't tell the story very well. Ideally, EBITDA needs to be calculated on an accrual basis. Now, some people's tax returns are on an accrual basis. Others are not. So it factors in accounts receivable and accounts payable as well. Typically, when we start talking about rules of thumb of multiples of EBITDA, we're really talking about adjusted EBITDA, which takes EBITDA, earnings before interest, taxes, depreciation, and amortization. It makes adjustments for anything included in the financial statements that's not applicable to a new buyer. That may be semi-personal expenses that are in the business that might include things like contributions, semi-personal travel, personal vehicle, and the like. Also, at this stage, we will adjust the compensation of the owners that may be in the financial statements to a reasonable amount for a hired manager. So that actually might be an increase or decrease. But those kind of adjustments are made. And then any significant non-recurring items that might be in there, for example, if you happen to have relocated the business and incurred $50,000 of moving expenses during the year, would not be relevant to a new buyer, those might be added back, those kinds of things. So that's kind of how EBITDA works. The next question we have is, how long does it typically take to sell a business in our industry? That's a really hard question. And it ranges from fairly short to a pretty long period of time, depending upon lots of factors. About the shortest it can take would be probably 3 or 4 months, and that would have to take, everything would have to be just exactly right from the day that you decided to sell and the preparation of the material. Let's say that took about a month, and then you identified a buyer and negotiated a deal within the next month, and then the process of moving from the negotiated transaction to a close taking a month or 2, depending upon factors including how the deal is going to be financed. For example, if many transactions are going to involve SBA, Small Business Administration, guaranteed loans, and those loans typically take 90 to 120 days to go through the process from application to close, and that's after you already have a deal done. So if everything went really smoothly and an SBA loan was involved, we're probably talking about a minimum of about 6 months. In many cases, it might take quite a bit longer than that. It may take longer to prepare on the front end, and it may take a longer period of time to find a buyer, depending upon what's going on in the market, what the nature of that particular business is, how attractive it is. Here's another question. If I could do one thing to make it easier to sell my business, what would it be? Well, I'm going to cheat a little bit and evolve that into more than one specific thing. But number one, keep it running on all cylinders, generating growing revenues and profits, and create systems that generate revenues and make it independent of you, the business owner. That process will make it much easier to sell and increase the value of your business. The next question is, how important is confidentiality in the business sale process? Well, I find that topic very complicated. Everyone wants to keep the process very, very quiet, at least the vast majority of people do. And I understand the reasons for that. However, just to be clear, the more confidential a proposed transaction is, the fewer buyers will hear about it, and probably the lower the price and the longer it's going to take to get a deal done. Because ideally, the highest number of potential buyers generates the best price, competition, and so forth. And so you just have to kind of work through that. Many people are particularly worried that their employees or their competitors, or sometimes their customers, will find out that their business is on the market. Typically, we have some ways to deal with that, but particularly in dealing with employees, we believe that it's a good idea to be pretty straightforward with them. And that doesn't necessarily mean making an announcement that you're selling the business, but it may involve, talking about the fact that the idea has crossed your mind, that you've gotten some unsolicited solicitations, and you're giving it some thought and that sort of thing. That way, when something does come up, it isn't quite as big a shock as it would be if they knew nothing about what was going on. Complicated decision process, and people handle it in different ways. Certainly, from our perspective, we try to handle things as confidential as possible, and certainly within the directions that our clients give us. I'd like to tell you a little bit about our firm, the Principium Group. We specialize as green industry transaction advisors and provide services related to mergers and acquisitions, exit planning, and capital formation. Typical engagements for us include exit planning, business valuation, strategic planning, consulting, seller representation, and buyer representation. We're very committed to providing a wide range of resources for green industry business owners. One of the main things we do is publish a monthly newsletter, Green Industry Merger and Acquisition News, which is read by several thousand people in the industry. We maintain a blog of up-to-date information at sellmygreenbusiness.com. We've published a couple of books, Green Exit Planning for Lawn and Landscape Business Owners, and How to Sell Your Green Business. We have a third book that is well on the way, which will be entitled Acquisitions as a Pathway to Growth in the Green Industry. That should be published in September or October. We publish webinars and podcasts, speak to industry groups, and write articles and special reports, all of which is available to you in the industry. Today, we're making a special offer for everyone that participated in this webinar. Will receive a free copy of our book, How to Sell Your Green Business. To get your free copy, please send us an email to ron@principiumgroup.com and specify whether you would prefer a hard copy or a PDF ebook copy. And be sure to include your mailing address so we know where to send it. Thanks again for joining us today. We appreciate your participation and look forward to the opportunity to speak with you. Give us a call at any time, 888-229-5740, or an email at ron@principiumgroup.com. Visit us on the web at www.principiumgroup.com. Thanks, and have a great day.